Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's program, we have FN Arena's Rudi Filapek-Vandyck looking at the return of optimism in the stock market. Is it too early to say the worst is behind us? And he looks at the tech stocks that he really likes going forward. And then we talk to Bogdan of Blackmore Capital, the guy who manages the Switzer Dividend Growth Fund. He's looking at the stocks that he's dropping and the stocks he's picking up. And one of the big banks is on the way out, and the telcos are on the way up. And finally, we talked to Arjun Paliwal of InvestorKit about why real estate prices in the regions are likely to hold up a lot better than people would expect. That's the show. Let's kick off now with Rudi Filapek-Vandyck. Thanks for joining us, Rudi.
Oh, happy to be here, Peter.
Yeah. Now, Rudi, a question I get from lots of people at the moment, particularly when you looked at what happened in the US on Friday night when Citi reported better than expected and up it went 13% and a big jump. Of course, that's probably short sellers worried about them, the Citi doing better than expected. But do you think we're seeing the bottoming process trying to happen on Wall Street and ultimately have an impact on us?
Peter, well, what I think is what we see is, and as per always, and in particular during tough times as 2022 is, we see a bit of a battle going on between, simplistic put, the bulls and the bears. Yeah. And those who are still a little bit bearish or cautious, they are still on the lookout to see whether we will have a recession next year. And those who are more on the optimistic side, they think like, oh, maybe we don't have a recession next year. And in both scenarios, the outcome is very, very different. If we do get a recession next year, and that is very much dependent on aggressive tightening by central banks and on persistently high energy prices, I would pretty much both see as the main factors there. Then markets can go down another 15, 20%, and they probably will, although not necessarily immediately. And if we don't get a recession, then it is well possible that we are witnessing the bottoming process after the big pull down over the past 5-6 months. And that essentially is the setup where we find ourselves, and in the middle of the year.
Yeah. But Rudi, are you surprised? I'll use the word surprised about the magnitude of the volatility nowadays on the stock market. When people ask me why, I say, well, internet trading, young people are now big players in the market, and they can be excitable, and they can. It just seems to be lots of things. Compared to, say, 20 years ago, the volatility seems, in both directions, seems quite new age, if you like.
Peter, for the volatility, I think there are multiple explanations, as per always. We also have an increasingly large contingent of ETF investors. Yeah. And that means if they sell an ETF, then a whole basket of stock goes out the window. We also have increasingly more automated trading these days with algorithms and so-called intelligent programs doing it. But I think, given the season where we are and given the general cautiousness in the market, volumes in the United States and in Australia are very low at this point in time. On my experience, when you are this close to the reporting season, many institutions, they sit on their hands, they don't do anything, because they really want to watch and wait for more clearer indications what comes out of the company's results. And that means on low volume, you can get really outsized movements either way. If you want to draw a joke about it, if I start looking at the stock, it will be up by 10% because no one else is looking. And that's basically the situation where we're in this close to the reporting season. there are very few institutional investors who are willing to stick their neck out because they prefer to wait for clearer indications from the reporting season itself.
Looking at a company like Citi, reporting better than expected, I think Wells Fargo did as well, but apparently Bank of America didn't. Are we likely to see that kind of story here as well, that some companies that have been belted up terribly by the market will come along and say, well, you're entitled to your view on the price of our company, but look, this is what our company's actually doing. Do you think there's going to be quite a lot of those sorts of stories, which will mean the market will say, gee, we got it wrong, we better buy these now? I'm not saying all stocks, but there's going to be some good businesses that might even be in the tech space, and probably I should go back to CSL, because you've liked it, I've liked it. One of our viewers called Anton has been bagging us for liking it at 245 and 255. Then got the 300. He has to give me an apology at 300, by the way, Rudi. But that's to me, it was a classic company. The market just overreacted to CSL, and I expected a bit of a comeback. Are we going to see a few of those sorts of stories, do you think, in reporting season? And if so, I want you to name the companies.
I'm going to disagree with you, Peter.
Oh.
We won't see a few of those. We will see a large number of those.
Good.
I think this is a. I think what we've seen in the US, we've already seen in Australia. I mean, unfortunately, we recently had a market update by Jumbo Interactive, and that turned out a disappointment, and the share price got shellacked. And we also saw Rio Tinto updating their quarterly, and that was also a disappointment, and they also went down.
So really, what company was that? That last one?
Rio Tinto.
Okay, right. Yep.
Rio Tinto.
Yep.
Yes.
I've heard of it.
And then we saw a number of other. Then we saw a number of other companies: BHP, JB Hi-Fi, and Eagers Automotive, and a number of others, actually coming out with positive market updates, and they're surprised to the upside. So it will be really swings and roundabouts this reporting season, and part of the problem is for investors is the long term versus the short term. As I like to joke sometimes, is that you actually want companies like CSL and a ResMed, for example, you want them to disappoint, because you know that it'll push the share price down temporarily, and then you can get on board buying more shares, because these remain very excellent long-term growth outlooks. On the other end, you will have companies that have gone down by 80, 85, 90%, and they might actually surprise to the upside. The result might not be as bad as thought, but it doesn't mean that they will prove to be very good long-term performers, and that's where investors will have to weigh up what comes out of reporting season. One more comment to make, Peter, in with regards to the two questions you asked. One is reporting season, the other one is whether we have a bottoming process. On my observation, when the market goes through very tough times, as it has had this year, the very first segment of the share market to start stabilizing and to regain their uptrend are usually the ones like CSL, ResMed, Cochlear, Technology One, Woolworths, etc. And if I translate that in a different environment, those are the all-weather, relatively defensive, solid, excellent franchises we have on the stock exchange. So essentially, you can say that part of the stabilization process, let's call it phase one this year, that is taking place, is done in a very conservative and cautious way. Investors have put their money where I believe is the lowest earnings risk for the months ahead. Yeah. But also, these companies are most likely going to offer the least risk if we do run into a recession next year, while still offering excellent growth opportunities for the years ahead. And those are actually the lower risk propositions in the market. And you can tell from, let's go back about 5-6 weeks to early June, that's where most of those share prices started stabilizing, and by now they are up quite a lot. If you look at, for example, the price action in CSL, in Technology One, in Woolworths, that's almost like someone shot an arrow into the air, and that's how the share price went.
Yeah. Well, in fact, Rudi, I wrote a piece on Monday looking at CSL, and it started to come out of its low on June 17. And I thought, well, people have been trying to tell me that CSL has been treated like a tech stock. Let's just see when the S&P 500 rebounded, June 17. And I thought that was quite interesting that was it. But you're right, it's a quality, inverted commas, tech company, and that's why it's being chased right now. Now let's go and then, okay, so me, you're sort of saying this is probably step one of the bottoming process, but the next step two could be down. Of course, steps two could be up, depending on what reporting season says in a losers versus winners sense. So Rudi, talking about those companies that you've already mentioned, are they good buying opportunities right now, do you think, for the person who's prepared to wait a year for really good returns?
I personally, I wouldn't chase now the likes of Woolies, Technology One, and CSL, although as we speak, those share prices are falling today, because they've actually had quite a good run upwards. Yeah. And as I said, we are still waiting for the results to come out. And even the Woolworths, which happened early in the year, they can have disappointment, higher costs. They are absorbing some of the price increases, so it is well possible. And actually, if you are a long-term investor, you actually want them to disappoint this month, because then you can snap up a few extra shares at a cheaper price level. I think the share market it is actually indicating to us where the lowest risks are and where the higher risks are. And I think those stocks, I think that the market has decided, they represent the lowest risk for disappointment here. So those share prices have now had a good run, and now we have to wait what comes next. But obviously we can look further, and there are still segments in the share market that might represent good value here on the premise that we don't see inflation continuing to going up in the second half, and that bond yields are not going up again. So if we and maybe at some point central banks have to pause a little bit. If that's happening, then there are a lot of companies that we label technology or growth companies in the smaller cap space, or the REITs on the ASX. Both of those three sectors, if you distinguish between technology and growth, then you have three sectors that the only thing they need is bond yields not to cause too much more havoc. And then a lot of those share prices actually look great value. Obviously, the great caveat here is, what are the results going to look like in August? And it is coming close now. We're 2 weeks away from August. Yeah. So we will get a lot of those answers. But my inclination would be that a lot of the REITs, at the very least, look very, very attractively priced here.
Which REIT do you like the best?
I own this one.
That means you must like it.
The best one I like is Goodman Group, but again, you probably don't want to chase us too hard. But there was a small cap REIT which is called Homeco Healthcare and Wellness REIT, and that's a relatively recent spin-off. The code is HCW. It is from the Homeco guys. It's a REIT that has healthcare assets like hospitals and GPs and etc. And they're listed, and obviously that should, all else being equal, quite a secure REIT, because the likes of hospitals don't go bankrupt easily. And I own that one, and I think it's heavily undervalued. But I also noticed the share price is up this week.
Okay, let's go to that's REITs. Now we've already seen a rotation into healthcare, and the three stocks you've mentioned, Cochlear, CSL, ResMed, and beneficiaries. Now my overall optimistic thesis, which will surprise you that I've got an optimistic thesis, Rudi, is that the December quarter is likely to be the quarter when the stock market could turn around. And my argument is reporting season comes through and it's not as bad as we expect. Inflation peaks over the next couple of months in the US. The interest rate scenario that you're talking about, the bond yields, they don't go back to 3.4%. They hover around maybe high twos, something like that. A recession doesn't happen in the US, as Mark Zandi from Moody Analytics tipped this week, but we still might see a slowdown in the US. So this is, I guess, the best case scenario. Under those circumstances, a rotation into tech stocks is not unbelievable, is it? Now, if that's right, that all under those circumstances, the good quality tech stocks, what are the good quality tech stocks in Australia that you like, that even if it takes till the March quarter of next year to see what I'm talking about in the December quarter, what tech stocks, if you had a lazy 100,000 sitting around doing nothing, what three would you put that 100,000 into?
Well, first of all, it depends on how you define technology. Some people would include car sales, Seek, REA Group.
Yep, exactly.
I agree with those.
Yeah.
And, I own two of them. Yeah, I think so. Those are great companies for longer term view. The only but I can add here is that you have to be comfortable with how the housing market is going, and economists are forecasting house prices will fall by 10 to 15, if not 20% next year. That will somehow have an impact, even for the likes of Seek, car sales, and REA Group, I would argue.
Yeah.
A more typical definition of technology would be to include Objective Corp, Xero, and in Altium. And everyone can see from price charts, they haven't nearly as fallen as much as many of the other the smaller technology companies, and there's a very good reason for that. They are better companies. Again, that's on the premise that we don't get a recession next year.
Yeah.
In particular, I noticed that there's some skeptics in how Xero will handle a recession. The UK economy is not looking very flash, and they are a very big player in the UK. So it's probably a case of short-term risks a little bit higher than normal, but long-term the trajectory is still looking very, very well there.
Yeah.
I'm probably still forgetting. One of the technology stocks I think that should be on everyone's radar as well would be a WiseTech Global. Excellent business model. Again, it has recently issued quite a positive market update, so the short-term risks should be quite benign. But then again, the share price has rallied now a lot, and I would be chasing it here.
Okay. But give me the three then. 'Cause I know for the headline, Rudi Filapek-Vandyck's 3 best tech stocks.
Okay, I'll give you one, and again, this one I definitely own, and it's technology. I think it's IDP Education, and it's at the moment I think it's somewhere around the $24 mark. It is basically a mid-30s share price. I think it will reward investors over the next few years, multiple. And if any indications are there, then the volume of students that is coming to countries like Australia and North America is rapidly approaching pre-COVID levels. This company is developing itself as the global leader in English language tests for students from developed markets who want to come to students from developing markets, I should say, come to universities and education institutions in countries like Australia, the US, Canada, and stuff like that. Future looks absolutely great. I've held this stock for quite a while, and I've kept it throughout all the turbulence. And I think the outlook should be great. But again, we'll have to wait and see how August is going to pan out, because maybe they have some higher costs, and maybe you never know. But again, if the share price gets a good old shellacking in August, my inclination would be I'd buy more shares.
Yeah.
Yes.
Rudi Filapek-Vandyck, thanks for sharing your wonderful market insights.
Thank you, Peter. Always a pleasure.
Well, joining us now is Blackmore Capital's Marcus Bogdan, who also manages the Switzer Dividend Growth Fund. And there's been a few changes afoot. We'd like to see what those changes are and why. But also, let's just kick off, first of all, with me saying hello to Marcus. Hi, Marcus.
Hi, Peter. Good to see you.
Same here. Let's just talk about what you're seeing in the market. Forward PEs, valuations now. Seems a bit of optimism is creeping back into the market.
Yeah, certainly a better month start. What we've seen so far in July, and what we have seen this calendar year is the market PE for the ASX 200 go from around 18 times back to around 12.9 times, and that has been driven by rising interest rates and this fear of inflation. And that's compressed valuations, and this is a global phenomenon. And we are now trading around 10% below our long-term average on a PE basis. Also, from a dividend yield perspective, at the beginning of the year, we were trading at around 3.9% dividend yields. Earnings have been stable in terms of revisions, and that dividend yield is now close to 5%. So there's certainly greater value in the market. I think what is critical now is the upcoming reporting season. But so far, there have been very few negative revisions to earnings, and that is encouraging.
Yeah. What I find really interesting when you look at the whole thing in its big and whole way, what we've had is a market probably over smashing companies on the supposition that they're not going to do well. And the companies are probably going to come in and say, well, we are doing well. And I guess we're not certain about the future, but so far, so good.
It is from an earnings perspective and from a demand perspective. We're still seeing the benefits of reopening. All of the retail channel checks that we're doing and what we also seeing more broadly, suggesting that we've got full employment and still strong consumer demand.
So I guess the bottom line for us is we just have to hope that inflation does peter out between now and the end of the year. And if that's not peter to disappear, but just start heading down, which will mean that the views on interest rates would be viewed as being over the top. And that'll be another great fillip to the stock market in the December quarter. How possible is that?
Well, I think you're absolutely right, linking the two together in terms of inflation and interest rates. And I think a critical measure for the market is understanding when we see a peak in inflation, and that will lead to sort of a peak in the interest rate outlook as well. And once that is understood, then I think there'll be a lot more comfort more broadly in the market to start to recover.
Okay, let's go and look at your preview and expectation about reporting season locally. Because at the moment, the Yanks seem to be doing better than expected, and that's part of the reason why Wall Street's up.
They are. There's been stronger results in the US, and the great fear in the US was that the margins would start to compress as costs were continuing to arise. But so far, the pass-through onto the end consumer has continued. And the channel checks that we've done in the Australian companies that we've seen is certainly the demand remains very, very sound. And so for the upcoming reporting season, we do see moderation in earnings growth, given that it was such a strong year in 2021. That's just a natural phenomenon that you will see a slowdown there. But we still expect to see earnings expansion rather than contraction. And that's another critical component to the underlying support of valuations for the market.
And I guess, Marcus, what's going to be a really important factor will be the sum total of CEOs' views on the future or outlook of their companies. If it's not as bad as expected, that will be great for the market. If it's worse than expected, it won't be good for the market.
Well, I think you are right. It'll be interesting to see how many companies actually give firm guidance. And I think just given the backdrop that we've got, the number of challenges that we have, the level of uncertainty there, I mean, there will be, I think, caution around guidance, but I think the evidence will be in the earnings reports and the returns that companies are continuing to get.
Okay, let's go to what you've done in your own portfolio. Have you reduced any significant holding, and have you added to others?
Yes, we have made a recent change to the portfolio. We have reduced our exposure to banks, primarily reducing our position in CBA, and that's primarily on the back of still a very high valuation for CBA, and also the expectation that loan growth, credit growth, will moderate as the economy slows with higher interest rates. And what we've done is to take that capital and add to our position in Telstra. We think that the telcos are more defensive in their earnings characteristics. Telstra has recently been able to put prices up by 5% for a range of mobile plans, and we're still getting a good dividend yield of around 4.1%, fully franked.
Great stuff. All right, now, you also like a company called Spark. Tell us about the company and why you like it.
Well, Spark is the equivalent in New Zealand of Telstra in terms of its heritage. And that provides a dividend yield of over 5%. And what we do like about the telcos is that they have a range of infrastructure assets which they're now starting to monetize. Spark has recently announced a sell down of their mobile towers, and that will generate sort of around $900 million, around 10% of their market capitalisation, which they will progressively use for returning capital back to shareholders. So defensive earnings, strong balance sheets, ability to put prices up, and then also the expectation of capital returns for shareholders.
Okay, one last question. We've seen every time there's a bit of positivity coming out of the US, tech stocks have had a nice ride up. Is this a sneak preview of what might happen if that scenario of mine of inflation's on the fall, the expectation around interest rates are pulled back? Once all that happens, do you think that's going to be another leg up for tech stocks?
Well, a lot of things have to happen, as you've just outlined, and whether we do see the sorts of moderations that you're talking about, we do need to see the peaking of interest rates, because that is so sensitive to valuation of growth stocks. But when you look at the valuations, yes, they have come back significantly, but they are still above long-term averages. And so we are not at the point where we're increasing our exposure to growth or tech yet, but you're getting much closer, or to cyclical. So we're still very much in that defensive industrial space, the healthcare space, and real assets, which will be a beneficiary of this high inflation.
Well, Marcus, you're a very defensive person. That's what we like about you. Thanks for joining us.
Pleasure. Thanks, Peter. Cheers.
Well, my next guest is Arjun Paliwal of a data-driven buyers agency called InvestorKit. Arjun, great to see you.
Great to be on again, my friend.
Okay, so Arjun, the subject is the regional areas of Australia which have done fantastically well. I figure it's done well because of the implications of the coronavirus and people working from home. But were the regions already becoming popular even before the coronavirus?
Yes, so this idea of everyone only started moving there after work from home became a phenomena is definitely incorrect. The trend was already on the way up prior COVID. It was supercharged though, because as the shackles of work life and how we adapt have been removed, there's definitely been an added layer of demand. But the constant across all of these markets that we've been analyzing across regional Australia is not so much just the demand side, but the heavy undersupply that is still apparent even today.
Yeah. And so I guess it's fair to say that there's always been a creeping movement of people trying to negotiate working from home. Was it really helped by the arrival of Zoom, video, and Microsoft Teams?
Well, that was definitely one core component. Technology has been a great enabler. Naturally, the pandemic being the shift in the biggest of movements, which is to do with how we had to adapt to work. But actually, another core part has just been attractive lifestyle. Attractive lifestyle and affordability has always been there. And there's actually always also been a segment of some jobs prior to this pandemic that offered work from home. But as we've all noticed, it has been supercharged.
Yeah.
I think what we're noticing more than ever is with the surges in prices across many capital cities and with the acceptance of work in many more regional areas, is the ability to be more flexible in which areas you choose. It might not always be the ones just by a capital city anymore. People are a little bit more broader than that in their thinking.
Yeah. Let's just talk about, the regional town that is symbolic of this extraordinary price increase. You correct me if I'm wrong, but I instantly think about Byron Bay. Is Byron Bay the pinnacle of what's happened in the regions in terms of the price increase?
Well, funnily enough, Byron Bay is an example of two components. One is the supercharge effect of the pandemic. That has no doubt applied a major shift of people, demand, and that lifestyle factor. But actually, Byron Bay's performance and its outperformance in eclipsing many cities was even here with us pre-COVID. Yeah. For many, many years prior to this pandemic, Byron Bay has been a choice for many of the wealthy and many of the lifestyle seekers to find that balance. And that's been a big part of some of the regional house price growth occurring.
Okay, now in your notes, you say that the regional property growth will continue in smaller, undersupplied areas, and you say there are 5 markets set to soar. So what are those 5 markets, and explain why?
Yeah, the first point is you touched on undersupplied. In any time when people are analyzing housing markets, especially during consumer sentiment drops like we're seeing today, the core things of housing fundamentals that factor into sentiment, demand, and supply, 2 of the 3 become very cloudy. Demand and supply. Supply is the one that's not cloudy, but demand and sentiment is the one that becomes cloudy. Yeah. And the reason why is that, supply is a data set that is just an actual. Seeing listings versus 2 years ago, 5 years ago, 10 years ago is very apparent, and it doesn't need to, be worrying about the why or what if that's happening or what if this is happening, like many things in the demand world do. So as a result, we focused our analysis on heavily undersupplied markets and areas such as Tamworth, Bundaberg, Toowoomba, the Barossa Valley, and even Albury-Wodonga showcased themselves in a series of undersupply data checks that we did. So it clearly means that, to some examples, to give you one, Tamworth has listing levels between 40 and 60% lower than pre-pandemic levels, which is no small movement at all. So this is huge, which means even if demand does pause or stall or consumer sentiment does come off, this huge undersupply will leave buyers with very little choice, continuing their price growth across many of the other reasons, like stronger economies as well.
Take Tamworth. What is the main reason why listings are so low? Because in the city, listings often drop because they think the market's going to be terrible. And like when the pandemic first started, listings fell until they realised that the listings that remained on the market did very, very well. So what is the pullback factor in Tamworth for listing?
it's been a mixed response from our on-the-ground component of the review when we do this analysis. The first component is just that roaring demand that was seen during the pandemic just outpaced the current listings on market, so the new just wasn't keeping up. And so as a result, it became such a tight floor. That was one of the things, and it just hasn't recovered yet. The second thing is that people are placing themselves at home, wanting to be there in that city. They're seeing the benefits of that lifestyle, the local economy improving. And as a result, people aren't shuffling and moving around or making large decisions as they were prior pandemic at the same volume. The main thing that we noticed, though, at the end of the day is supply is one of those data sets where if you don't have a core reason or can't quite identify it, it's okay, because the outcome is still the same: houses for sale or less houses for sale. And so from that perspective, there's definitely less houses for sale in the areas that I've picked up prior to the pandemic.
It's interesting, mate, when I think about it, Tamworth, Albury, Toowoomba, Bundaberg, I forget the fifth one, but they're all great centres. I know when I drive to Melbourne, I call into Albury, and that place is just growing. You know, massive Bunnings, massive Harris Farm markets. It's an extraordinary growth thing. You can imagine why people don't want to leave.
Yeah, the lifestyle is definitely a core factor of them, and it's beautiful that many parts of Australia now get to actually put it on the map and see it, feel it, experience it. I think a year or two of not traveling the whole globe and just seeing what we have to offer locally, as well as what many of these cities have, also offer from a price point and affordability perspective, there's no wonder why many people are happy to stay put or are calling it home. But the real thing here is that many people are just not putting their houses for sale. It is tough times for many of the selling agents who wanting to get a hold of more stock. They are working that little bit harder for it. But the vendors are being rewarded quite nicely with increased pressure and in turn increased pricing.
And does it mean that some suburbs in the cities of, say, Sydney and Melbourne suffer when there is a high demand to go into the regions, and they probably won't improve until immigration levels start to pick up?
Yeah, it's a great point you raised there, Peter, because immigration levels play a big factor into the rental market. Now, what's possibly surprised many is how strong the rental market's been, even as the immigration or the borders have been shut. And so the borders now open, are definitely seeing more and more people come through, but the numbers are nowhere near the prior levels. So yes, when you see exodus, when you see less people coming in, there is a net negative effect of certain components of Sydney as an example. But that one reason alone isn't the core factor. I think the main factor here for Sydney's slowdown is that alongside the sentimental changes and the monetary changes, the listing levels are at a balanced component. We're back to our 5-year listing level averages. They're still well below their 10-year averages, so it's not extremely oversupplied. But when you see demand come off because people are wondering, is this the right time? And when you see sentiment shift, those areas that carry that balanced supply tend to get a little bit weaker.
Yeah. I've always seen over the years that one of the best indicators that a market is suffering lower prices is when auction signs become for sale. And when they start increasing in number, you know that the sellers are having difficulty getting the prices that they think their property's worth. Definitely.
I think we're clearly seeing a shift in percentages on auction clearance rates in our major cities like Sydney and Melbourne. We are also in other cities that tend to have a little bit less supply. They're not getting the same levels of price growth as they were late last year, because the key component is that is not sustainable if you're thinking price growth like that exists forever. In any strong city with strong fundamentals and low supply, we don't expect those prices to get back to those levels of growth, but we do expect some of the cities I've named here to have some healthy performances when you compare it to national averages over the next year or two.
All right, Arjun, thanks for joining us, and let's hope you're right.
Thank you.
Cheers. That's Arjun Paliwal from InvestorKit.
And that's the show for tonight. Thanks for joining us. Remember, you can get more information and more tips on stocks by going to switzerreport.com.au. Thanks for joining us. See you on Monday night.